Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what we're looking at in the markets, what we're doing in our portfolios. As always, please don't use these for trading purposes. They are for information only. I always start with a weekly chart of the S&P 500. Here, you see this goes back to 2021, late 2020 there, all the way on the left side. And we've had a nice uptrend here since the bear market in 22 when the Fed was raising rates. We've had a really nice uptrend. Did see earlier this year, the start of 2025, got off to a pretty rough start there coming into April, but has since recovered and gone all the way up to new highs. Definitely seems to be getting ahead of itself a little bit, but as always, we just try to trade what we're seeing in the markets and not predict what might happen. So we do have a nice uptrend on the weekly chart there, so nothing to run away from. And we go here to our daily chart. Gives us a little more detail, and you can see that, this gives us the last couple of years of trading. Again, here's the start to 25 as we had a nice sell-off to sort of begin the year there in February, but since then has recovered, and then we're getting in an uptrend here. You see, about a week ago or so, we did have a nice sell-off starting, and there was some weakness in the market that I'll show you. Certainly got us a little bit conservative for the moment, and now we're retesting, and actually we're on to all new highs as of right now. Not sure where we're going to close today, but we'll see. But did break some of the trend line there, did break some averages, but didn't really come across below the major, the top there from the start of 25. So still in an uptrend here. Just had a little bit of a scare for a couple of days, but and as you know, if you're paying attention to the news, it's very headline driven based on whether we're going to have tariffs with other countries and stuff like that. So very difficult to see what happens when you get news like that. It can just have a very quick reaction in the markets. We come down here to a little more detail, our 2-hour chart. This will give us about the last 6 months trading on the S&P 500, and you can see the trend channel that we've been following going up. Did hit the bottom of it and then kind of bounced back, but we did get a little less risk off as that started to happen, and I'll show you some of the reasons why that happened. But we'll also let's look at some of the internals on the market here. This one is the bullish percent of the S&P 500. It's the percentage of the S&P 500 that's currently in an uptrend. And as you can see here, when August started, we got the sell-off. We had been rolling off the percentage of stocks that are in an uptrend in the S&P, and right now it's actually only 56%. So we're at all-time highs here, but only 56% of the market is holding up. And a good example of that, if we go back to in March here, you start to say, okay, the market's recovering, we're going higher, but then you just start to see this percentage roll off, and that's what we were seeing. You can see as it comes down from 56%, it had been in the mid 70s through May, June, July. That's lessening now. Doesn't mean the market's about to sell off or anything, but it is something that you want to watch when less and less stocks are actually holding up the market. Come to an advanced decline line. That looks good. It's been probably, I guess you call this flat here through this period, but for most of the year through April, I guess that's a nice uptrend, just flattening in recent weeks. And then finally, the VIX, the volatility index. That's the amount that people are paying for insurance on their portfolios for protective puts to keep their portfolio from going down. It had a brief spike there in August, and that's part of why we looked at taking some risk off. That as the percentage, the S&P that was in an uptrend was lowering, and the VIX got from a spike from 14 to 21. It looked a good spot to do that, but it's come right back down, and things are stabilizing. So for now, we're still in an uptrend here, even as we're just hitting the all-time highs. But we'll see how that closes. We look at some other internal measures, things that are inside the market. One, the ratio of consumer discretionary stocks to consumer staple stocks. we would expect in a poor market, a defensive market, that consumer staples are going to do better. So we would really see this ratio start to fall, and it did there. End of July, we started seeing that sell off a bit. And again, you can see that in that ratio. We did have a nice sell off here to start the year 25, and that was happening. It looked like it was starting something in August, but then it's just reversed right back as some of these trade deals get announced that, hey, everything's fine. We come here also, the ratio of technology stocks to utility stocks, that was also selling off start of August, but it seems to have recovered now in the last couple of weeks. Same biotech over healthcare. We had a little bit of a small sell-off there to start of August, but since recovered. And also this was had a more pronounced move, the ratio of hotels to utility stocks. Again, we would start to see that really decline in the face of a decline like we had in April. And you can see all of them did that in April, and may have started to in August, but as some of the trade deals kind of get announced, that's reversed since. So we'll see how that all plays out. We're a little defensive right now, not entirely so. That's for sure, because all of our larger term, our weekly chart, everything like that are still pointing up. We come here to interest rates. This is the interest rate on the 10-year U.S. Treasury. Again, flat, been in the same range here for years. You come back here to 23, and it's just been sitting in this mid 4% range that it's staying in right now. So nothing to be concerned at on the interest rate side. We go to economics, GDP growth rate, or it's around 3.2, their annual growth rate. Those are steady, they're fine. Payroll, non-farm payroll numbers, these are not good numbers, but I know there's some, maybe there's some government layoffs going on and things, but they're still positive. And then finally, we go to retail sales. They're a bit positive, very weak, but still positive. So nothing there to panic over. But they're not the greatest. Finally, go to valuations. What we would want to see, the S&P 500, say around 20 times earnings. That would be this line right here at 43.33 is where the S&P would be, and currently it's 64.32. So we're quite a bit ahead of ourselves in terms of earnings, but the market can do that from time to time. That is for sure. So again, just something to keep in mind for the time being. Again, all-time highs here. Weekly chart looks good. Daily chart after a little head fake is back to good, and the internals, a little concerned about the weakness in the economy, and certainly the fact that we only have 56% of the stocks in an uptrend, meaning there's just a couple of the winners that are really holding up the market. That can be a very dangerous situation. So hopefully this was helpful and informative. I'm going to put up our contact information here, and if you'd like to hear more about what we do for clients in their portfolios, please don't hesitate to reach out. Otherwise, hope this was helpful, and we'll see you at the next update. Thanks so much.